Breaking news, concerns over the coronavirus outbreak, and once again, they are affecting the stock market. Look at that right there. Wall Street ending one of the worst weeks of trading since the financial crisis in 2008.
The US stock market last week decided that the coronavirus is finally here. The Dow 30 companies, 30 big US companies, fell from over 29,000 points to just over 25,000 points. That's down about 13%, while at the same time, the gold futures went up about 1.3%. Today we're going to talk about gold. We're going to talk about what some of the best investors think of that precious metal and something to consider potentially in your portfolio. We don't recommend anything, we don't recommend gold or anything like that, but we're going to do some education and explain some of the things, pros and cons of gold in a portfolio. Let's start by listening to Ray Dalio on what he thinks of gold.
You recommend that most portfolios should contain some gold. Why?
Yeah, of course.
Why? A lot of people think it's not of course. In fact, it doesn't make sense.
Well, first of all, to structure a portfolio, the best way to structure a portfolio is to have the right kind of balance in your portfolio. So, and some amount of gold. Gold serves a purpose. It is, first of all, a diversifier against other assets. You know, we have this risk-on, risk-off thing. We also have a monetary system. The Bretton Woods monetary system began after World War II, and it had the dollar as the world's reserve currency. There's a risk there. There's a lot of dollar-denominated debt and so on. If somebody that felt that they didn't want to hold that and so on, you could have exposures to that. So it's a diversifying asset that is sensible, and you know, that's the main reason to have gold in the portfolio, 5 to 10%.
Ray Dalio talks about a risk-on, risk-off situation, stocks rising when the risk is on and stocks falling when the risk is off, potentially going into things like cash or bonds or potentially something like gold. He talks about a scenario where there's a lot of US dollar debt in the world, and that one day, if people don't want to hold US dollars anymore for whatever reason, money printing or whatever it is, that they will then sell US dollars and potentially go into something else, something potentially like gold. He talks about diversifying a portfolio to give it the best chance so that if there's a big downturn. Med Fabian of Canberra Investments did a research topic on this, and he looked at the dot-com bubble and the global financial crisis. In the dot-com bubble, he looked at the fact that the top 500 companies fell over 40%, while at the same time gold rose over 27%. In the global financial crisis, the top 500 companies fell over 50% and gold rose 18%. Now, there's no rule to say that when stocks fall, gold rises, not at all. In fact, that October 2008, in that 1 month alone, gold fell 16%. So the idea is more about diversifying. It's not about some rule that down stocks means up gold. And so it is a very controversial topic, is gold, and let's listen to what Warren Buffett has to say on the subject.
Decent productive asset is going to kill a non-productive asset over time. I will guarantee you that farmland over 100 years is going to be gold, and so are equities.
Why do you think gold bugs get so irate? Because they really come out.
Yeah, it's very interesting. If you go on CNBC and say that bonds are kind of a poor investment, you know, people don't get mad at you. You don't even hear from the Treasury. I mean, you can knock almost any investment, and people may get a little irritated. But when you talk about gold, and of course that says something about their motivations for ownership. They want people to agree with them. They want everybody to get so scared they run to a cave with gold. And caves might be a better investment than gold. I mean, at least they're not producing more caves all the time. So they want people to be as afraid as they are, because that's what's going to produce an increase in prices. Incidentally, they're right to be afraid of paper money. I mean, they have their basic premise that paper money around the world is going to get worth less and less and less over time is absolutely correct. But
you just disagree with the investment theory beyond that.
Yeah. Where they run from that, and they should run from it, is where, in my view, they make the mistake. But they have a correct basic premise.
Warren Buffett talks about productive assets and non-productive assets. Productive assets being farmland where things are produced and sold, whether it's companies like Apple or Google or Microsoft or any other company that makes something, General Motors and cars, producing things. He says they're better assets than, for example, non-productive assets like gold that just sit there and look pretty and don't actually make you any money at the end of the day. Historically, gold has been seen as a store of value where people put their money just as savings. but not as a way of making a lot of money. It's more about just saving money. It's not so much that gold is going to make you a lot, but potentially if fiat currencies, things like Australian dollars or US dollars, and Warren says that over time people are right to be afraid of fiat currencies in that they will devalue over time and lose value. So the premise of gold makes sense, but he says there's better things out there than gold. He doesn't think gold's very good himself. Now we've heard different opinions from Ray Dalio, gold being a good diversifier, from Warren Buffett as gold not being as good as other things. Now it's up to you to think and to learn and to understand what you think about gold and your own perspective of that. We don't give any advice on this channel, it's purely educational. If you do want some sort of advice, you can click the link below and it'll give you some advice on balanced and diversified portfolios, and you can go from there as well. Otherwise, I'm going to see you in the next video.